Can you get rich from the banking crisis? Here we are again in another banking crisis, but this time you can make millions. The financial crisis of 2008 and the greatest recession that followed are still fresh in the memories, and here we are again in another banking crisis. But the big difference this time is that you now have an alternative to the traditional financial system, the decentralized system of cryptocurrencies, mainly Bitcoin and Ethereum. As the banks fail, crypto goes up. And as the bailouts begin, crypto goes up. And as QE under a different banner begins, it sends crypto soaring. Remember, the more the traditional financial system struggles, the more it legitimizes crypto. So, how can you make the maximum amount of money while the traditional financial system fails? Nobody wants to fall victim to these banking crises, so you shouldn't miss this whole easy-to-understand video. But before I start, subscribe to Invest Addict and put some appreciation there. First of all, we need to know how to fully capitalize on the problem. We need to know who we are competing against. So, to fully capitalize on a crisis, we need to fully understand the problem. Actually, it's really simple. There are two levels to what a bank is. It is the deposits that they have, and that's what makes them a bank. And then it's what they do with the deposits. They invest them. In a normal course of events, banks make businesses by something called the steep yield curve. They borrow at like 2% interest rates, meaning that you pay 2% on your deposit, and they lend it out to the market, and 5%, that's the yield curve. That's a longer-term duration that they take the risk on. The problem is the yield curve got massively negative this time. In fact, the second most negative yield curve since 1980. That means that the banks ordinarily would have to pay you 5% or 4% interest on your deposit. But then they invested in the bond market in 20-year bonds or 10-year bonds or 30-year bonds, and they actually get less money. So, they're losing money every day. The issue is people have the freedom to move their deposits. They can move their deposits out of this 0.5% world into a 5% world of cash deposits, Treasury Direct, and money market funds. And that means deposits shrink from the system. As they shrink, you have to unwind the longer maturity bets. But the problem is that those are all underwater because the Fed raises rates so much. So then they have got mark-to-market losses. But to collapse the deposit base, you have to realize those losses. And then suddenly, they have all got no money. That's the real problem here. So, with the Fed raising rates at the fastest rate in history, this has practically screwed the banks, and now they don't have any money. And so the Fed is forced to do QE, but under a different banner, which has already begun, and they have printed half the money, which has taken them a year to reduce in just last week. So, to make money from all of this, we need to comprehend what we are competing against. And the answer is the central bank's balance sheet. We need to outpace the debasement of the currency, or have assets that are rising in dollar terms. But you're still getting poorer. And so the question is, which vehicles are going to outperform the printing of money? The answer is, when the central bank prints money at a certain rate, the S&P should double that performance. The Nasdaq will do even better, and crypto does the best. We will be seeing a new all-time highs in the stock market in less than 12 months, and that means crypto is going to the moon. Over the past 12 months, the Fed's increased interest rates at the fastest pace in history, which has led to another banking crisis. People have been taking their money out of bank accounts where they're getting 0.1% and into bonds where they're getting close to 5%. And the Fed has quickly had to reverse its QT policy, printing $300 billion in just 1 week. And today, announcing opening swap lines, which can bring trillions of new dollars into the system. And as investors, the key is to be able to outperform the printing of money. And based on your own personal risk profile, you may have a number of options. To take the least amount of risk, you have bonds. For more risk and more return, you have gold. Then a good choice would be technology stocks. And for the biggest upside potential with lots of volatility on the way, you have Bitcoin and crypto. After the financial crisis of 2008 and the Great Recession that followed, people saw their portfolios lose 30% or more of their values. And older workers saw their 401k plans and IRAs drop to levels that threatened their plans for retirement. But instead of acting rationally during severe bear markets, many people tend to overreact and make matters worse. Many people panicked or were forced to sell assets at low prices. while a small group of patient, methodical investors saw the stock market collapse as an opportunity. Investing in crisis is no doubt risky, and double-dip recessions are a real possibility. And attempting to pick a bottom is largely a matter of luck. Still, the investors who are able to invest in a crisis without surrendering to irrational fear and anxiety may reap outsized returns during recovery. While most investors are panicking as asset prices descend, those with a cool head are able to see the resulting low prices as a buying chance. Buying assets from those unsettled individuals driven by fear is like buying them on sale. Often, fear drives asset prices well below their fundamental values, rewarding patient investors who allow prices to revert to their expected levels. Profiting from investing in a crisis requires discipline, patience, and enough wealth and liquid assets available to make opportunistic purchases. When calamity strikes, markets fear the worst, and stocks are punished accordingly, but when the dust clears, optimism returns and prices bounce back to where they were, with markets responding once more to fundamental signs. Stock markets are not only the way to invest in a crisis. The Great Recession also saw a collapse in home prices, as people who could no longer afford their mortgages foreclosed and many homes were underwater. The mortgage amount owed to the banks surpassed the equity value of the property. Home buyers and real estate investors were able to pick up valuable real estate at below normal prices. Just remember, those with cool heads, discipline, and an understanding that, historically, markets have always rebounded can purchase assets at bargain prices and earn excess returns. And that's all for today, guys. What do you think? Let me know in the comments. Make sure to give this video a thumbs up and subscribe to my channel so you don't miss out on the amazing content. Until next time.